Nature, aka Nature. Alright, so gang, we're back for another video. In this video, we're going to be talking about the different relationship between margin and leverage and what margin and leverage is. So what is the relationship between margin and leverage? You can use margin to create leverage. Okay, leverage is the increase of trading power that is available when using a margin account. Okay, so leverage allows you to trade positions larger than the amount of money in your trading account. Leverage is expressed as a ratio. Leverage is the ratio between the amount of money you really have in your account, the amount of money that you really have, and the amount of money that you can trade. Okay, so that's what leverage is. Okay, so leverage is the ratio between the amount of money you really have and the amount of money you can trade. It's usually expressed with an X to 1 formation. For example, if you wanted to trade one standard lot of USD JPY without margin, you will need 100,000 in your account. But with a margin requirement of just 1%, you will only have to deposit $1,000 into your account. The leverage provides this trade will be about 100 to 1. Okay, the leverage that's provided through that trade will be 100 to 1. Here are the examples of leverage ratios depending on the margin requirement. Okay, so the margin requirement for Euro USD 2%, JPUSD 5%, USD JPY 4%, Euro Aussie 3%. Alright, so this is the leverage ratio for that is 50 to 1, 20 to 1, 25 to 1, and 33 to 1. Okay, so this is 50,000 to 1, 20,000 to 1, 25,000 to 1, and 33,000 to 1 as far as your margin, as far as your leverage ratio is concerned. So we're going to explain that right here. So here is how to calculate your leverage. So your leverage equals 1 divided by the margin requirement. For this example, margin requirement is 2%. Here's how to calculate leverage. So 50 equals 1/0.02%. So the leverage is 50, which is the expression of the ratio of 50 to 1. Here are the calculated this is how you calculate the margin requirements based on the leverage ratio. So margin requirement equals 1/leverage ratio. Okay, for example, if the leverage ratio is 100 to 1, here's how you calculate the margin requirement for that. Okay, so it will be 1/100 to 1, 0.01. So the required margin is 0.01. Okay, 1%. As you can see, leverage has an inverse relationship to margin. Leverage and margin refers to the same concept, just slightly different angles. When a trader opens a position, they are required to put up a fraction of that position value in good faith. In this case, the trader is said to be leveraged, okay, to that trader. The fraction part, which is expressed in percentage, turns into a margin requirement for 2%. The amount of money that's required to put up is known as the required margin. For example, 2% of 100,000 position size would be 2,000. The 2,000 is the required margin to open this specific position. Since you are able to trade 100,000 position size with just 2,000, which your leverage ratio will be 50 to 1. Okay, so leverage equals 1/the margin requirement. So for 50 to 1, it will be 1,000 divided by 0.02, 2,000, and it will give you a leverage ratio of 50 to 1. Okay, so in this example, it would be 10,000 divided by 0.02% of 10,000 is 200, and that gives you a 50 to 1 ratio as well. Okay, so Forex margin versus security margin. Forex margin and security margin are two very different things. Understanding the differences is important. In security world, margin is the money you borrow as a particular down payment, usually up to 50% of your purchase price, to buy and own stocks, bonds, or ETFs. This practice is often referred to as a buying margin or buying on margin. So if you're trading stocks on margin, you're borrowing money from your stockbroker to purchase stocks, basically a loan from the brokerage firm. Okay, so in the forex market, though, margin is the amount of money that you must deposit and keep on with your trading platform to keep it going when you open a position. It is not a down payment, and you do not own the underlying currency pair. Margin can be looked at as a good faith, a deposit or collateral that's used to ensure each party slash buyer or seller can meet their own obligations of their agreement. Unlike margin, stocks and trading, margin in forex trading is not borrowed money. When trading forex, nothing is actually being bought or sold, only agreement or contracts to buy or sell exchange. So borrowing is needed. Borrowing is not needed. The term margin is used across multiple financial markets. However, there is a difference between how margin is used when trading security versus when trading forex. Understanding this difference is essential prior to trading forex. Okay, so I just wanted to go over that, what was margin and leverage, and this is the margin jargon cheat sheet that I promised you guys. Alright, gang, so as you dive into the world of margin trading, it may feel like you have to learn entirely new language to truly understand what's going on. Just as with any specific area or specialized area, margin trading comes with its own terminology and jargon. Here are handy cheat sheets to most common terms you may come across in trading platforms. Okay, margin. Margin, the definition of margin is the amount of money you are required to deposit with your trading platform in order to order and maintain position in the forex market. Margin is used as a collateral to ensure that you can cover any losses you might incur on your position. Okay, leverage. Leverage is the ability to trade a larger amount with just a smaller amount of money in your account. Unrealized and profit and loss. Unrealized profit and loss is a current profit or loss that's held in your open position until it's closed. Okay, it's also called a floating profit or loss because it's just floating around as a current profit or loss and held in that open position until you close it. Okay, balance. Okay, balance is the total amount of cash you have in your trading account. If you have an open position, even if it has a floating profit or loss, your balance is still the same as before you opened the position. But once you close that position, the profit or loss will be added or deducted from your balance, and this will be your new balance. Also called account balance and cash. Okay, so margin requirement per position. Margin requirement is the amount of required margin. Margin requirement is the amount of margin required to open a position. It is expressed as a percentage of the full position size or the notational value of that position you wish to open. Required margin per position. Definition of required margin. Required margin is the money that is set aside and locked up when you open a trade. For example, if you open a 10,000 mini lot position with required margin of 2% or 51 leverage, that's a 51 leverage, okay? It will be 200 will be locked up during the duration of that trade, okay? That's the required margin for that trade, 2%. This is $200 can be used to, this $200 can't be used to open other positions, as long as that trade is open. Once you close that trade, then the 200 margin will be released and you can open up new trades. It's also called the entry margin, the initial entry margin, or maintenance margin required. How to calculate per position is the base currency is the same. The base currency is the same as your account currency. So required margin is the notational value times the margin requirement. If the base currency is different from your account currency, then you would do the required margin equals the notational value times the required margin. Okay, times the exchange rate between the base currency and the account currency. Okay, so use margin, the definition of use margin. Use margin is the minimal amount of equity that must be maintained in a margin account. This is the total amount of all the margin currencies and used to maintain open positions. It's also called margin used, maintenance margin required, or total margin. How to calculate the total margin or use margin is simply the required to simply calculate all the use margin. Use margin is simply the required margin for all open positions. Okay, so for all the open positions of all the required margin, that's how you find your use margin. So the use margin is totally equals the total requirement of margin for all open positions. Equity. Definition of equity is the account balance plus the floating profit or loss of all your positions. Represents the real-time value of your account. Okay, it represents the real-time value of your account of all your open, all your floating and profit losses, profits and losses in your account in your open account at that time. So it represents the real-time value of your account equity. It's also called the account equity, the net assets value, and the net equity. So how to calculate the equity. So if you have an open position, equity equals the balance plus the floating profit or loss. If you do not have an open position, equity just equals your balance. Okay, so free margin. Free margin is the money that is not locked up due to any open positions and can be used to open new positions. Okay, so it's free margins. It's not locked up. You can use it to open new positions. When this value is at 0 or less, the margin warning is triggered and additional positions cannot be open. Okay, when the value is locked up, when the value is at 0 or less, then the margin that you have, you get a margin warning, and we already went over margin call outs and call levels, so that's what you get, and it triggers, and once it triggers, any additional positions cannot be open, and any additional positions that are open, if you get the margin warning, if it goes less than 100, any positions that are open, your broker will start, closing the positions that are open so that they can bring your margin level back up if it goes to a certain level. So it's also called, as far as free margin, it's called free margin, available margin, usable maintenance margin, available to trade. Okay, so how to calculate free margin? It will be the equity minus the used margin, and it will give you your free margin that you have to trade for available new trades. So margin level is the ratio between equity and the used margin. It is expressed as a percentage. For example, if your equity is 5,000 and your used margin is 1,000, the margin level is 500%. It's also called the margin indicator. So how to calculate margin level equals the equity minus the used margin times 100. Okay, so the margin call level is the specific level percentage, where if your margin level is equal or below it, you won't be able to open new positions. If it goes to 100 or equal to that, you won't be able to open new positions. You'll get a margin call level. Your margin call level is the trading platform determined by your trading platform is determined by the margin call level. Some margin call levels are 100, some are 50. For example, if the margin call level is 100, this means that your margin level reaches 100. You won't be able to open any new positions at this point. Your account is now under a margin call. Even though most new traders assume this means that their trade may be closed, that's not true. A margin call level is just a warning. Okay, it's warning you that your trade is going to 100%, and you're getting, and it could go back against you, and it might not. If it goes below 100 though, it starts to go to the 50, the stop out level, which is 50 or 20%. Then your broker will automatically start liquidating your trades and start closing your trades, starting from the biggest loss all the way up to all the way up from your biggest loss all the way up to the next biggest loss and the next biggest loss until your margin level goes back up to 100% or higher. So margin level is very, very serious. Also, it's called minimum margin requirement or minimum required margin. So how to calculate the margin call level equals the margin level x the percentage, okay, of whatever your percentage is as far as your margin level. It wants to be at 150, 200, 250, 500, okay? So those are all good percentages. If your margin level is high, then you're good. You don't have to worry about nothing. So that's also very important. We're going to be doing some live trades and be showing you guys that game, as far as the margin level is concerned. Stop out level. The stop out level is specific level percentage, where if your margin level is equal or below it, and it goes below it, then your broker will automatically start closing your positions until your margin level is greater than your stop out level. Okay, until your margin level goes back up to 100, 150, your broker will start automatically start closing your positions, starting from the biggest loss, all the way up to the next biggest loss until it goes back to your margin level. Okay, so that's what a stop out level is. It's a specific percentage or level where if the margin level is equal to it or below it, then your broker will automatically start closing your positions until until your margin level is greater than your stop out level. Okay, so that's what stop out level is. For example, let's say that your stop out level is 50%. This means that if your margin level falls below 50%, a stop out will automatically occur in your positions floating. The largest loss will be liquidated automatically first. Following the process will be repeated until the margin level increases to a level above 50% or 100%, depending on some brokers. So also it's called liquidation of margin, margin closeout, margin closeout, and minimum required margin. So how to calculate that would be the stop out level equals the margin level at a certain percentage. Okay, so this is the margin call. Definition of a margin call. Margin call occurs when you have breached the margin call level but still above the stop out level. A margin call is a warning telling you that your account isn't doing too well and that you are close to having your open positions liquidated at the market by your broker. You are still allowed to keep your current positions open, but you cannot open new positions. So that's what a margin call is, okay? And then you have the stop out, okay? So definition of stop out which happens when the stop out level has been breached, okay? And when your open positions will automatically close out by your broker and be liquidated to prevent a negative account balance and them from, just coming on your door and knocking at your door with a gun or a bat. Before they do that, they allow us to trade $100,000 in leverage. Before they allow us to blow their whole account, blow their money that they give us as far as, leverage is, they're going to stop us out, automatically. Once you reach a certain stop out level, and your positions will automatically start to be closed out and liquidated to prevent you from having a negative account balance. Okay, so again, that's really all it is. This is the cheat sheet. That's all it really is. You made it far past this video. You made it this far. And that's congratulations. And we're gonna keep posting. I'm gonna keep on giving y'all as much content as I can. We will be doing live trading soon. And, we're just gonna run it up and get this money. Just keep doing that. So alright, gang. It's your boy Nature, aka Nature Gang.